Equities are falling sharply this morning, led by technology stocks, following Microsoft's warning provided yesterday post-close when they reported earnings that sales are slowing. This after they, along with several other mega-cap tech companies, announced sizable layoffs recently. So is the worst of the bad news behind us, or does more trouble lurk ahead? For that, we'll delve into what the options markets are anticipating for the markets generally and technology stocks specifically today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Joining me today, again, Garrett DeSimone. He is an academic, he is an economist, and he's also the chief quantitative strategist at OptionMetrics. And, we're seeing a lot of weakness in technology stocks today, and Garrett's going to be telling us a little bit about what the options markets are implying. For those that don't know, this is an area that is very near and dear to my heart because we actually run an ETF that uses option sentiment to pick stocks, long stocks only, and also balance how much we invest in equities versus how much we keep in cash. And to give some sense of whether or not that can generate any alpha, I actually have a couple charts that just show how things have been going over the course of the last several months. Perhaps we can pull up first a chart of our performance on the OAIE ETF relative to SPY, which is the S&P 500 ETF, or at least one of them, probably the most well-known, and XLK, which is the Select Technology Sector ETF. And what we can see is that this is, again, just picking long stocks. We managed to generate some pretty handsome outperformance relative to the S&P and to XLK. And if we pull up another chart that shows the volatility that we exhibited, you'll notice that the volatility was equal to or less than those other two ETFs. And the reason was that when the options markets are signaling trouble, we tend to allocate more to cash. Now, just a quick point I want to make sure everybody understands. This is more for purposes of demonstration. This isn't a solicitation to invest in the ETF or anything else. But I just want to make sure that everybody understands that this is an approach I think is an important one. It can generate meaningful alpha. And for that, I think we can get right into it. So Garrett, it's great to have you back again, and I'm really looking forward to hearing your insights. Happy New Year.
Happy New Year. Thanks for having me back, Mike.
I know you're a little bit under the weather today. I hope you feel better soon, but I appreciate you joining us and working your way through this. So give me first a little bit of a high-level view on how you think the options markets can be used just as a gauge of risk, as a gauge of opportunity, and what you're seeing right now and how you like to look at it.
Sure, absolutely, Mike. So one of the most common measures that we look at is our very popular fear indicator, which is a measure of a VIX from the CBOE. And the VIX, in terms of how it's predicted from day to day, we don't find a lot of strength whether a high level of VIX predicts the future market returns, for example, or the next day returns. But what the VIX does tell us is that it's a benchmark indicator of how much investors are placing in options premiums. And this is where the term fear comes from. So when the VIX is very high, we expect investors to spend a lot more in hedging by buying options and thereby pushing up the price.
Yeah, so I guess, when people think about the fear index, just as a general guideline so that people who are not familiar with the VIX index, what it is, the VIX index uses SPX options, and you take a strip of those options, and essentially what you're doing is calculating what the implied volatility, the implied variance really for the market is over the course of the next 30 days. That's not necessarily an indication the market's going to go higher. It's not necessarily an indication that it's going to go lower. You're just basically taking this big strip of options and getting one number to distill what the volatility looks like. But actually, there's a lot of information embedded in options prices. Some of it actually can give us more of a view on directional sentiment, right? So we can calculate price-weighted probability distributions and all kinds of fancy stuff like that. What is it that you like to look at, and what is it that you're seeing right now that you think folks ought to be paying attention to?
So one very popular measure is a sentiment of downside risk pulled from the options market. And this is what we call the implied volatility skew. So essentially what we look at when we look at the skew is what is the cost of out of the money puts, which are typically used for hedging downside moves and crash risk versus the price of out of the money calls. So when you expect investors become really concerned about downside risk, let's say it's due to earnings, let's say it's due to macro news, you'd expect that skew to go up because the price of puts is increasing relative to calls.
Yeah, I mean, I guess my question to you would be, in general, we would expect to see puts trade at a bit of a premium to calls, wouldn't we? A couple of reasons for that. One of them is flow-based, and that is that people like to use options to hedge their portfolios. That creates a greater demand to purchase puts, arguably, than to sell them. A common option strategy that many like to employ is selling covered calls. So that is just selling upside calls against stocks that you own. For those that do that, that would naturally create excess supply on the call side. And then finally, I think something that probably is worth thinking about, but maybe not many people do, is that volatility for equities individually can increase as prices fall. You know, people often say that they take the stairs up and the elevator down. And also correlation tends to increase. And as correlation increases, then the volatility of an index that holds those correlated assets is also going to increase. So if you have stocks that are going in different directions, the index that contains them is not going to move around that much. But when stocks fall, correlation rises, a lot of them start falling together, then volatility would increase for that reason as well. But I assume when you look at this, you like to sort of normalize it, right? Come up with a baseline case. So we generally expect to have a certain premium to puts relative to calls, but still we're very interested in how that relationship changes through time. Have you seen any changes recently that you think are worth paying attention to?
Yeah, first I'd like to highlight the differences between the single name skew and the index skew, and particularly what type of investors are focused in each. So if we look at the index level skew, and we look at investors that are mainly buying puts, these are institutional level hedgers. So they have a natural demand to hedge their broad-based portfolios or use, let's say, puts so they can allocate risk somewhere else. So when we look at the skew on, let's say, the SPY or SPX, you would actually expect it to be much steeper compared to single name stocks. Now, if we look at the skew based on single name stocks, for example, those tend to have more, let's say, retail focused traders or more individual stock bets around earnings. So the skews actually tend to be a lot smaller and more balanced in terms of where the direction falls.
Yeah, out of curiosity, when you're looking at that, we were actually just talking about Microsoft. There are a lot of tech companies that generate tremendous amounts of cash. You may remember many years ago there was a point, and I think Apple had a valuation of about $450 billion at the time. That should give you some sense of how far back we're talking. And it was pointed out by a lot of market observers that they had in excess of $100 billion in cash on their balance sheet at the time. So every share of Apple was maybe 25% cash, and the rest really was the value of the enterprise. And of course, what's interesting about that is that cash doesn't have a lot of volatility, right? So what you would see in a situation like this is that there was actually more call skew than there was put skew, because if the stock fell, say, 50%, then it would suddenly be 50% cash. So the volatility would be getting increasingly compressed. Do you guys try to normalize based on those types of factors for single stocks as well?
Yeah, absolutely. So when we look at some portfolio strategies or we look at back tests, we typically like to normalize by taking the volatility, the at the money volatility. So in the graphs we're going to look at now, we're just looking at the raw skew, but over long periods of time, we'll divide by the average volatility and kind of look at portfolios based on that measure. But I'm also
so maybe
glad
we can pull that
the cash component, Mike, because the interesting thing about single name skews too is that securities that have a lot of debt or are, let's say, on the there's a lot of risk involving bankruptcy or possible default, that also attracts purchases on the put side too. So what you'll typically see in securities that have a lot of default risk, they'll actually have very strong skews as well.
Right. And I think that's an important point, that the skews are a function essentially of that risk component more than they are just a function of cash. And I guess the example I would provide that is evidence of this is if you take a look at staple stocks, a lot of staple stocks have relatively heavy levels of debt, but they also have very stable businesses, and consequently the risk that they're going to have negative cash flows, the risk of default, is very, very low. And so the skews there might be significantly less, despite relatively high levels of debt, than they are for companies that are both indebted and are in volatile businesses and have volatile cash flows. So with that, why don't we take a look at the chart that you brought along, and maybe you can tell us what it is that we're looking at here.
Yeah, I'll walk you through this a little bit, Mike. So if we look at the first red line, that is our skew on SPX. And what we see is it typically averages around between 5 and 6%. Now, if we go back until 2017, what we see is during periods of turmoil, we get this spike. So during the Corona pandemic, we had a spike of the skew up to almost 30%, which is what we'd expect when there's extreme levels of market aversion and extreme concern about crash risk. We would expect that investors are willing to pay more for puts. The next thing I want to
actually ask you a quick question about that? When you say 30%, maybe you could tell us what exactly people are looking at here, what 30% represent. Are you looking at this in terms of moneyness, delta, sigma? So just so we know which call we're comparing to which put, or how you're calculating the skew.
Sure. So we're looking at the 60-day surface from our proprietary volatility surfaces. So these are options that are averaging about 60 days out. And then what we do is we take our 25 delta put minus our 25 delta call, and then we subtract the two values and we get our measure. So if I said that skew had a measure of 30%, it would indicate that puts are 30% more expensive compared to calls on a volatility basis.
Okay, so as we see this gap, and then when I'm looking at this chart, what I see is that most recently, the blue line, which is typically below the red line, these two have crossed. What is that telling us?
Yeah, so to move on to the blue line, to give you a little background about that, that is our average measure of our FAANG skew values. So that's our Facebook or Meta, Apple, Amazon, Netflix, and Google. So this is just, we take an average measure of what their skew values are and present it in a chart. Typically what we've seen over the last 5 years and in general is that these skews are much lower than what you'd expect on the index. And that's for two reasons. One, we talked about it earlier, is the fact that the index is dominated by institutional investors that have a need for puts due to hedging. But the other reason is the index is comprised of multiple constituents. And it's when you buy a put on the index or an out of the money put, it also serves as a hedge against correlation risk, because in falling markets, all of your assets become correlated together. So they all fall together. So most of the time, you'd expect the skew or the out of the money puts to be more expensive on the index level. Now we compare that to the single name securities. These are much more balanced. So sometimes it even hits a level of 0 or positive, meaning that and we talked about this earlier in the show, Mike, that there is a weighing of upside compared to the downside in these single name stocks. So investors are buying, let's say, more calls because they expect there to be a higher probability of upside moves. But when we look at the cross, we find something very rare that's been happening, let's say, mid last year, is that these single stocks have become more expensive to hedge on the downside than the index overall. And that indicates two things to me. One is that the index is probably not pricing as high correlation risk going forward. So what that might mean for 2023 is we could have a mixed bag in terms of the sector performance in the SPY constituents or SPX constituents. The other factor it addresses to me is that the market has become very concerned with individual earnings and firm-specific risks.
Yeah, I want to make sure I heard that correct. Did you say that the cost of hedging the downside in the single names exceeds index. Is that what you were just saying? I just want to make sure I got this right. So that the
Yep,
skew
on
in
a implied
individual names is
volatility.
greater than it is in index.
Yep, that's correct.
Interesting. So that suggests to me that if you were trying to put on, let's say you wanted to put on now this is going to get a little bit wonky for some viewers who might be less familiar, but I think it's just a question I would love to have answered, which is, it is possible to trade just correlation. You know, when you use options, you can do all kinds of things. You can create non-linear returns for an underlying asset. You can come up with different ways to trade the constituents of an index to the index itself. If I own options in equal measure on a weighted basis for all of the individual constituents, and I'm selling index options in a similar fashion, I am making a bet that individual stocks returns are going to disperse, that they are going to go in other directions. That's essentially being long dispersion. On the other hand, if I get long index and short the individual constituent volatilities, I'm getting long correlation. And in theory, one can do this in a path-dependent fashion. That is to say that I don't have to have a tremendous amount of exposure here, but I could say buy downside index puts, sell downside constituent puts, and essentially I end up with a path-dependent long correlation trade. It sounds to me like right now, if I was trying to put on some form of a path-dependent correlation trade, that I can put that on at a more favorable level than I might have been able to historically. Is that something you would agree with?
Yeah, absolutely. So what we're essentially seeing, and keep in mind that there is a reason these skews are higher also, but the notion is here that these FAANG stocks are pricing in much higher downside relative to what the index level is expecting. And at the same time, too, if we're looking at how the index has fallen relative to this, we see a big dispersion between what we'd expect the stocks to perform in terms of correlation versus what the sort of the sentiment around the macro. So this provides a really interesting opportunity for anybody looking to get into that kind of correlation trade.
All right, now I'm going to put you a little bit on the spot here, and I know that you're not necessarily a stock picker, you're not running a book, so I'm not going to ask you what's in it. But as you just take a look at the landscape for single stock options and skews as relative to index, do you think that we are entering a period of lower risk relative to, say, the past 6 months, equal risk or higher risk? And by the way, I mean, the last 6 months have been a period of elevated risk for equities. I think that's been borne out by their returns. And we have diverging views by those who believe that the worst is over for technology stocks, number one, because the prices have declined, because multiples have declined, because they believe that the pace of increases in interest rates will also decline, and that the rates themselves might potentially decline, which would be, all else equal, probably bullish for stocks. And I say all else equal because falling interest rates may largely be driven by weakening economic conditions and not necessarily just supposed to be some kind of a propellant for risk assets. What if you had to say is your risk gauge telling you for the next 3 to 6 months?
Yeah, absolutely. Without any direct investment advice, just looking at kind of the macro backdrop, if we start with the expectations around how the market is priced in falling inflation, if we look at, let's say, tips, the market is really pricing in a return to normalcy of about 2% inflation by the end of the year, which would be a historical drop by any measure. And I think that has partly driven the rally we've seen in the last month in tech stocks as well as the NASDAQ mainly. So the concern there is what if we don't match that expectation, this very rosy expectation which the market has projected? The other factor I think poses a big risk is that we do have some increased optimism regarding the Fed slowing its rate path, but we're still in an inverted yield curve, which really it doesn't make me feel good about having an extremely heavy or long, mainly long equity portfolio. Negative yield curves environments have not borne out well in terms of whether the probability of predicting recessions. They're pretty spot on.
Yeah, I mean, I guess here's the way I like to think about it. There's a couple different things that could happen. One thing that could happen is that the market's expectation of falling inflation is correct, but the market's expectation of declining economic activity is also correct. Not a great outcome. Another possibility is that the market is incorrect about the inflation picture, and inflation proves to be more persistent than the market's anticipating. And the market, by the way, is usually a better handicapper than the Fed is. So all else equal, I'm probably going to bet on the market before the Fed. But let's just say that that's a possibility. That too would not be a great outcome. And the final possibility is that inflation does moderate, but the market is wrong about the economic picture. And so we see economic activity essentially normalize or even increase. That's three possible outcomes. Two are not so great. So as we look forward, to me at least, that suggests caution is probably the way we should be thinking about it. Is that kind of the way you're looking at it too?
Yeah, absolutely. I think over the last month, we've priced in this best case scenario of us reaching 2% inflation by the end of the year. And to add to that, it's much easier to bring inflation down from the high 8% levels down to 6. But I think in terms it'll be much more difficult for the Fed to bring it down from 6 to 2. And there's no moving the goalposts. There have been some pundits mentioning why not move it to a 3% target, but that would completely destroy their credibility. So even if we're sitting at 3%, and Powell has made it very clear they're going to crush inflation. So sitting at 3% is not their target. I think it's still a risky backdrop for equities.
Yeah, I mean, even if they brought inflation down to 3%, or even if they brought it down to 2%, we still have a lot of sticky, elevated pricing that has not essentially been caught up with by things like wages. And that's often where inflation problems become persistent. Prices go up, they stabilize at some new level. Wages will then, over some period of time, elevate to try to catch up with them. And that's sort of why you get this wave effect, I think, in inflationary increases. And it's the thing that we all need to be cognizant of and cautious of. Garrett, I really appreciate your insights today. As always, I think they're really valuable, and I'm very much looking forward to the next time we get to talk about what you uncover next. Thanks for coming.
Thanks for having me, Mike.